Thank you to Hamilton ETFs for sponsoring this video. Now, if you invest in the S&P 500, like myself, it shouldn't come to a surprise to you that your returns are highly driven by tech and the Mag 7. In fact, as of today, the Magnificent 7 represents roughly 30% of the entire index, with the largest players like Apple, Nvidia, and Microsoft respectively representing over 5% of the index each. In fact, the top 10 companies represent nearly 40% of the entire S&P 500 index. Now, at times, this absolutely works in your favor. And there will be times, however, where it doesn't and it works against you. And in today's video, I want to share with you guys an idea that could potentially reduce your portfolio risk, the volatility, importantly, while still earning comparable returns to the S&P 500. Because if you recall, about a month or two ago, I did a video announcing the launch of the Hamilton Champions ETF suite. We discussed some of the benefits of a fund suite like this, such as additional diversification beyond the tech sector. Of course, a focus on dividends, higher yields than what the index currently offers. We talked about how the focus on lower beta holdings and getting exposure to these high quality, proven dividend stocks, that is a major factor and opportunity in reducing the risk and drawdowns of your overall portfolio. Well, fast forward to today, we have a case study where we see exactly how a fund like this can help with reducing that overall portfolio volatility without again sacrificing on returns. You see, over the past few weeks, we all heard the news, we had the S&P officially dipping into correction territory. We'd seen the longest losing streak since 2022 with the S&P declining a number of weeks in a row, and stocks that I will remind you represent a large chunk of the S&P 500 like Nvidia, were down about 13% at the time of filming, Meta down 19% off highs, Tesla, we know how much they've been hammered as of recently. And we're seeing really live, at least over the past couple of weeks, how this large concentration of the index into tech and really the Mag 7 stocks, that weighting can really at times impact and affect an investor's portfolio and their returns. Now, important, I am not by any means suggesting that we shouldn't have exposure to the S&P 500. That's far from what I'm saying. And I'm certainly not saying that we shouldn't have exposure to these mega caps, the biggest companies in the world, which have been driving a lot of the growth over the previous years. But what I'm trying to get at is that if you understand the nature of a market weighted index, which is what the S&P 500 is, if you understand the current breakdowns and how your money is allocated amongst the various sectors at the moment, and of course, how that allocation ultimately breaks down to your portfolio risk and the volatility expectations that you should expect as an investor. Now, I want to share an idea with you guys, something that you could look into. And what we'll highlight today is ticker SMVP, which we covered as well in the previous video. This one in particular is the Hamilton Champions U.S. Dividend Index ETF. This, in my opinion, is a very interesting case study. You see, SMVP, the index that it's tracking is the Selective U.S. Dividend Elite Champions Index, which includes US or American companies with at least 25 years of dividend increases and no dividend cuts. This is an equal weighted index, by the way, where we look at the diversified sector allocation. What jumps out to me is the inclusion of only 6.4% to the technology sector, at least as of January 31st, 2025. Now compare that to the generic S&P 500 exposure, which is ballpark 30% of the S&P exposed to tech. And what we see is that over the past month or so, while the S&P has fallen into correction territory, again, drawn down by our mega cap tech stocks, they're currently sitting down about 8.5% at the time of filming. We've seen the Selective US Dividend Elite Index, again, what SMVP is tracking, hold up extremely well, posting a mere 1.17% decline. Let's just call that essentially flat. Now, keep in mind, what's important here is not just the drawdown, but as we discussed in the previous video, you also have faster time to recoveries, the higher dividend yield, and overall reduced volatility. What's incredible is historically still providing similar total returns to the S&P 500. And as a reminder, you're getting exposure to some of the highest quality dividend names out there with a very different sector exposure than the S&P 500. So why do I bring this up and where do I see this coming into play? Well, of course, as always, be sure to do your own research and due diligence, make a decision that makes sense for you. But the way I see things is, as mentioned, This doesn't mean that we shouldn't be exposed and investing in the S&P 500. Absolutely not. That's a critical component of how I choose to invest. But where a fund like SMVP, for example, could come into play is possibly like a complementary hold. As history suggests, this index is returning similar or comparable holds to the S&P 500 while at the same time reducing your overall portfolio risk. And keep in mind again, thanks to these lower beta holdings, the less aggressive sector exposure by nature, investors that would be exposed and following an index like this, well, they've seen a smoother ride, a smoother investing experience with less volatility, less drawdowns during these market corrections. It's basically a way, in my opinion, of diversifying beyond just the S&P 500 and just settling for the various sectors that the generic S&P 500 offers, especially if you resonate with the concept of dividends and dividend growth and picking companies with this proven track record of consistently growing those earnings. That's something that you guys know I've bought into for a long, long time for my personal strategy. Of course, we're talking today about SMVP, but as a quick reminder, you have various options as part of the suite, which include levered and unlevered versions. So as I called them in the previous video, generic dividend options. You have options for Canadian dividend exposure. You have options for US dividend exposure. I will include a link with you guys below this video to visit and learn more. You can dive in on their website, but I did just want to put this quick video together. I thought the timing was good. I thought it was an interesting case study where when the markets do correct and the tech market starts to perform poorly, it's a great example or a great scenario where you see the value and benefit of these type of holdings when you look at it in your overall portfolio strategy as a long-term investor. Let me know what you guys think down below. Let me know what you think of the Hamilton Champions dividend suite in and of itself. And I once again will thank Hamilton for sponsoring today's video. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.